Okay, great stuff. So I said the hardest bit of this was working out cash flow from operations. The next one, cash flow from investing, which is we have done a lot of the work for it, which is why that was a 28-minute long video. Sorry about that. Was to do with cash flow from investing, and you saw the amount of work we did here. Just cash flow from investing. So this was the PPE, and so really the the cash flow from investing, because this was really done via lease, via loan, this new plan. So the cash flow from investing was this 723, if you like, via the additions that we have. And we, because the three wasn't cash, the three was we didn't actually get that. We didn't sell this separately. This was a part disposal. So we have the 723 there from investing. And then we also got this government grant. So let's look at the government grant and see what happened there with the government grant. So you can see what I was saying earlier on. So you start here. You start at the opening balance here of 200. You have a closing balance here. So I can see I have a higher figure on this side. So it must mean I must have received, if I do all this here. So we put government grants under cash flow from investing because typically the government is giving us money towards the purchase of new assets or something along those lines, if you like. And so that means that we must have received cash, debit bank, if you like. And of course, this must be what we received must be this 310 minus the 160 minus the 40. And so we must have received in the bank 110. So we have further cash flow from investing of 110. And what we also notice is that with intangibles, we see here, we started with an opening balance here. We had some impairment. So we must have bought something. So we must have had an outflow because this is the closing balance. So really, here I have here, when I do my totals, I have 486. Again, like I say, it's you almost need to know the things in there so that you then are just aware in terms of filling out doing the differences. And I have therefore minus 410, and so it means I paid out 76 for some intangible asset, and it tells us that it is good, it is goodwill. So I have payments to acquire non-current assets of 723, and then I also have this government grant that I received of 110, and then I also have the purchase of goodwill, which you've just seen me do as well. Right, and that's the cash flow from investing. Very straight. Then let's look at my sort of, if you like, financing activities. If I look here again, like I said, so I have here. What do I have here? So I will just. So during the year, yes, during the year, it says that we exchanged, we acquired this new plant at a cost of 120, but that was just the sort of lease. It's part of the loan. So it says the company acquired some plant at a cost of 120 from Bromway. So what we now have, therefore, is that when we do our double entry, if you notice here, when we got this new plant, we would, of course, recognize this. I suppose I'm just going to put it here. I could create a new one and call it lease liability, or not lease liability, but a separate loan. But anyway, key point is it says that you did receive, but not cash. That was just, you got the new plant and they recognized this liability. But you also received, therefore, I mean, if you have a closing balance of 800, it means you must have gone debit bank to receive a further. So they gave you 200, but 120 of it was to do with the new plant. So this was the actual cash receipt. So this is where, again, like I say, this is where it just moves up a little in terms of at this level. But it's just almost like being able to separate out the two, that the 120 was to do with the new plant straight, and they recognized the liability, but there was no cash involved because you were getting a plant. And then you got an extra 80, which is why you have this, you got 80, if you like, in cash. So you have this closing balance, therefore, don't you, of 200, if you like, on both ends. And yes, where am I? Bold, I'll leave that there. So you got 80, if you like, come in. So 80 comes in, if you like, from the loan. We have that. And then let's see what happens with your ordinary shares. I can see from here that from ordinary shares you had started with 400, so I can tell that 100 came in. So I'm just going to put 100 in here. Must have come in, if you like, and that's why I have here a closing value of 500, right? It must be the sort of the situation here, here of 500. I'll just bold that again. So you received 100 here, if you like, from that. And I'll look at share premium as well. So the same thing would have happened with share premium, if you like. Extra would have come in, so 120 must have come in, right? Because this is closed at 90. So you have there 90, and then you have there 90 as well, and then you have there bold. I'll bold that. So I have 20 coming in from share premium. Debit, of course, debit 120, credit ordinary share of 100, credit share premium of 20. Then we paid out some dividends, didn't we? Let me just deal with those two first and see where we are with those. So here you are, issue of ordinary shares, 120, issue of dividends, 80, preference dividends of 35. Yeah, preference dividends of 35 were the same because what happened was you put through an expense of 35, right? You put through an expense of 35 in your preference dividends, and you have exactly the same carry down figure. So you must have paid typically the full 35 in your year out, if you like, through the bank. So that's what happened. You'd have recognized the expense here. That's the expense. You can see of 35. So this would have been, of course, this would be 335 here, and here the same thing here of 335. Sorry, 385 here, all bold. So let me just so that means that, so let me just go back here, and that is the 35 movement that whoops, sorry, where am I? Here we are. That's 35. Where is it? Sorry, let me just, I think here we are. That's 35 going out. And the dividends paid of 220, yes, it's told us straight away. A dividend of 220 was paid during the year. Because you see, we're not going to see this dividend in the income statement. We're going to either see it in the statement of changes in equity, or we're going to be told. So you paid out 220. And it tells us here as well, although we worked it out, that the full preference dividend was paid during the year. So we can see straight away that 35 was paid during the year, as well as this full dividend of 200. And so we have that, and we have that, if you like, in that, where is over here. Oops, sorry, I'm just finding the actual statement here. Yes, here we are. So we've dealt with that. And so we have all these figures here of 55. That's the cash flow from investing activities, the 689. This probably was the trickiest bit, wasn't it? The payment to acquire the non-current asset. You really had to be awake, but it's important to know that you've acquired some assets, but not all of it was paid. The 120 bit was a loan, if you like, and then the difference was the actual cash received from loans, and then you had the rest, if you like, as being the balance on that statement. It has to be the balance. And so you have that net cash flow from operations, net cash flow from activities operating, so 647 minus 689, and cash flow from financing, so less this as well. So you have this difference of 97, which is exactly what we know. We started with 34 cash in the bank, and we ended up with 63 liability by the end of the period. And you can see here, they do it in sort of straight line, but they do some T accounting as well, which is really helpful. And you can sort of see, there we are. So you can review all of this, that double entry as well. I think when we look at this, it says that it's best to set up a page for reconciliation, a page for statement of cash flows, and a page for workings. So literally just do all of that. You need to almost set up 3 pages, if you like. And then it says work down the statement of financial position, the movements of trade receivable payables. And then, it says you may want to set up workings for the remaining balances, either using columns or T accounts. Then work through the statement of profit or loss, then the notes, if you like. So, I think it's just taking your time to get a handle on how you actually play with this. Play with this. Right, so please, please, please go through TYU1. I think these are interesting exercises to work on. They're very good. Work on TYU1, work on TYU2, um, and really, please do these exercises. And it's the same process, really. Um, and work on that. Here we are. So some of the just to finish off this lecture, um, some of the things here. Advantages, of course. This is cash we're talking about, right? We can clearly see liquidity, viability. It's all very there. It's all very clear. You know, you can't really lie about cash. We can see the relationship between profitability and cash generating ability, and then we can see the quality of the profit earned. So yes, we see profit, but we also know what the cash really was in terms of from operations. And cash flows cannot be manipulated easily. It's very difficult to manipulate cash flows. It's just cash. So the big advantage really is that you cannot manipulate cash. Yes, I mean, well, it says there's some scope in terms of paying suppliers until the year end, but you lose goodwill, and cash is necessary for survival in the short term, but profitability is still critical over the long balance. So a huge cash balance is not a good sign. We just wanted to. I don't think that's the. I think the point is to just make sure that you can pay dividends. Statement of cash flows are based on historical, and therefore don't provide a complete picture for assessing future cash flows. That is true. It is all historical. It's still historical, even though it's to do with cash. Right, and again here, you can use it to look at things like dividend and interest payments, management of financing. It's really about, can you pay your interest? Are you potentially a going concern? What's the cash flow from trade? Are you over trading? How quick, trade receivables, a number of those, things. So again, the key point really is, again, the key point here is you want to be able to meet your short-term liabilities, really. So in terms of working capital management, really important to manage your inventory, manage your suppliers, manage your customers. Overtrading, again, is the key point here. We're trying to avoid overtrading. So overtrading is selling a lot of things on credit. So great high profits, but you're not getting the cash in time. So that's the problem. So your very good your profitability is amazing, but you're not getting the cash in time. And of course, can you beat your dividend and interest payments? Critical. And if you were to go along there and start buying goods, do you have cash available to actually meet your capital expenditure? That's sort of the big point there. Right, awesome. And I think that's kind of the main point with that chapter, and we will see some of this interpretation when we look at financial interpretation. But the key point here is we're constantly trying to see how we can balance those three things: cash flow from operations, cash flow from investing, and cash flow from financing. Okay, great stuff.